Welcome. My name is Troy Atkins, and I'm the founder of Atkins Capital Management in New York City. Today, I want to walk you through one of the most consequential financial decisions most Americans will ever make, whether to buy a home or rent one. Now, you've probably heard it 1,000 times. Renting is throwing money away, or owning a home is the foundation of building wealth. But here's the thing, neither of those statements is universally true. And in this presentation, I'm going to show you exactly why, with real numbers, a real methodology, and a framework you can apply to your own situation. By the end of this video, you'll understand the hidden costs most people completely ignore, how the math actually plays out over 10 years, and the 5 key factors that ultimately determine whether buying or renting wins in your specific market. Let's get into it. Here's what we're going to cover today. We'll start with the executive summary, the big picture takeaway. Then we'll meet our two hypothetical individuals, Alex and Troy. We'll dig into what most people forget to include when they run the numbers, then look at the actual 10-year financial results, and walk through a detailed wealth trajectory chart. We'll also break down the methodology, how we calculated every single number, and then explore the 5 key factors that swing the decision one way or the other. We'll run a full sensitivity analysis across 36 market scenarios, discuss the price to rent ratio, leverage, career mobility, and wrap up with our conclusions and recommendations. There's a lot of ground to cover, so let's begin. The core insight of this entire analysis is this. Many people, in fact most people, believe that owning a home is always the better financial choice. However, our comprehensive analysis reveals that this is not necessarily true. The right answer depends on 3 things: how long you plan to stay in the home, the conditions in your specific local market, and critically, what you would do with your money if you chose to rent instead. This case study follows 2 hypothetical individuals. One buys, one rents. Both start in the same market, at the same point in time, with the same amount of money. And we track exactly how each of them fares over a full 10-year period. The results might surprise you. So let me introduce you to Alex and Troy. Alex decides to buy a house. Troy decides to rent. They're both living in the suburbs of a major Midwest city in the United States. The time period is 2015 through 2025, a full decade. And here's the important part. Both of them start with exactly $115,000 saved. Same market, same starting capital, different decisions. We want to see who comes out ahead, and more importantly, why. Before we get to the results, I want to spend a moment on something that most people completely overlook when they think about owning a home. These are the hidden costs of home ownership, the ones that never appear in the mortgage calculator on a lender's website. Let's go through what Alex, the buyer, is actually paying for. First, interest payments. Over the first 10 years of a mortgage, Alex pays $163,567 in interest alone. That's money that builds zero equity and that could have been invested in the market. Second, property taxes. Over 10 years, that's more than $60,000 out of Alex's pocket. Third, maintenance and repairs. At a standard 1.5% annually on the appreciated home value, we're talking $75,000 to $86,000 over the decade. Roof repairs, HVAC replacements, plumbing. It adds up fast for Alex. Fourth, Insurance. Alex pays roughly $2,500 per year in homeowners insurance compared to just $300 a year for Troy's renter's insurance. That's $22,000 more over 10 years. Fifth, opportunity cost. The $100,000 down payment Alex made. If that money had been invested instead, it would have grown substantially. And finally, often the most forgotten number, closing costs. It costs $15,000 to buy the home. And when Alex eventually sells, she'll pay 6 to 7% in commissions and fees on top of the sale price, which works out to over $40,000 on a home that's appreciated to around $670,000. Now, what does Troy have going for him as a renter? He pays only $300 a year for insurance. He has zero maintenance costs. The landlord handles everything. He has full liquidity and can move for better career opportunities without penalty. And most importantly, all of his savings can go into diversified market investments from day one. These advantages are real and they're significant. Most rent versus buy comparisons simply don't account for them. Now let's look at the actual numbers. This is where it gets interesting. In year one, Alex's total monthly housing cost is $3,360. Troy's is $2,225. That's already a $1,135 monthly difference. By year 10, Alex's costs have grown to $3,819 per month because property taxes and insurance scale with the appreciated home value. Troy's costs are $2,896 per month. Rent did increase, but it still remained meaningfully lower over the full 10 years. Alex's total cash outlay is $541,631. Troy's is $305,646. That's a difference of nearly $236,000 in out-of-pocket spending. Now here's the bottom line. After 10 years, Alex, the homeowner, has a net gain of $109,342. That's not nothing. She came out ahead of where she started. But Troy, the disciplined renter who invested his savings, has a net gain of $284,379. That's a $175,037 advantage for the renter. There are two categories where Alex wins. One is predictability. Her fixed mortgage payment gives her more certainty than Troy's rent, which can increase. And the other is forced savings. The home builds equity automatically, even if Alex isn't particularly financially disciplined. But in every other metric, monthly cost, total outlay, liquidity, and final net worth, Troy wins. Let me walk you through the wealth trajectory chart, because this is where the story really comes to life. Alex starts in the red. The combined transaction cost of buying and eventually selling, about 10% of the home value between a 3% purchase cost and 7% eventual selling cost, immediately create a financial hole. On top of that, in the early years of a mortgage, nearly all of her payment is interest, not equity. So Alex's net worth line starts below zero and climbs slowly. She doesn't cross into positive territory until approximately year 3.5. Troy, by contrast, starts positive on day one. His entire $115,000 is invested and compounding immediately at a 7% return, the historical average of the S&P 500. On top of that, he's saving roughly $1,000 per month compared to what Alex is paying, and he invests that too. Both streams compound continuously, producing the accelerating upward curve you see from year one forward. Here's the critical moment on the chart, the year 3 to year 4 crossover. where Alex finally climbs out of negative territory. At that exact moment, Troy is already setting at approximately $190,000. Alex just broke even. Troy has been compounding for 4 years. At year 10, Alex lands at $224,342. Troy lands at $399,379. The shaded gap between those two lines in years 4 through 10 represents Troy's $175,037 advantage. And if you extend that chart further, the gap continues to widen because compounding is relentless and Troy's money had a 4-year head start. I want to be completely transparent about how we arrived at these figures because the methodology matters. For Alex's final net worth, here's the step by step. We start with the home's value after 3% annual appreciation over 10 years, which brings it to $672,000. We subtract the 7% selling costs, which is $47,040. We subtract the remaining mortgage balance of $320,358. That gives us $304,563 in cash from the sale. We subtract the original $15,000 in closing costs when she bought. We subtract the $120,985 in cumulative extra monthly costs Alex paid versus Troy. And we add back $55,764 in tax savings from mortgage interest deductions. Final net worth for Alex, $224,342. For Troy's investment portfolio, the math is simpler. His initial $115,000 invested at 7% for 10 years grows to $226,205. His monthly savings of approximately $1,000, consistently invested at 7%, grow to $173,174. Final investment portfolio for Troy is $399,379. One important footnote on taxes: since the 2017 Tax Cuts and Jobs Act, the standard deduction roughly doubled, and the SALT deduction was capped at $10,000 per year. As a result, many homeowners, especially in the Midwest, no longer benefit from itemizing their deductions. This means Alex's tax savings could be even lower than what we've shown here, which would increase Troy's advantage beyond these numbers. Every great analysis is only as good as its assumptions. So we want to be completely transparent about the world Alex and Troy live in. We chose a $500,000 base home price with a 20% down payment, the classic gold standard. We used a 4.5% mortgage rate, which was standard in 2015. On the ownership side, we factored in 1.2% for property taxes and 1.5% for maintenance. That $7,500 annual maintenance budget is what most people ignore until the roof leaks or the HVAC fails. On Troy's side, we set the rent at $2,200 for a comparable home, with a 3% annual inflation rate. For his investments, we used a 7% return, which is actually conservative compared to the historical S&P 500 average during the time period under analysis. We also factored in the 2017 Tax Cuts and Jobs Act, noting that for many in the Midwest, the standard deduction is now so high that Alex's mortgage interest doesn't actually provide the tax shield it used to. Now we know what you're thinking. Sure, Troy wins in that one specific scenario of assumptions, but what if the stock market crashes? What if the housing market booms like it did in 2021? To answer that, we didn't just run one calculation, we built a wealth matrix. And what you will see is a heat map of success. We won't be just looking at the base case anymore. We will be looking at the probability of success. So let's stress test our analysis. We ran 36 different scenarios varying home appreciation rates from 1% to 6% per year, and varying investment return rates from 3% to 13% per year. This matrix shows in each scenario how much Troy comes out ahead or behind Alex after 10 years. The results are striking. 32 out of 36 scenarios favor the renter. Only 4 out of 36 scenarios favor the buyer. Those 4 buyer win scenarios all require a specific combination: home appreciation of 5 to 6% annually and stock market returns of 7% or below. Let me highlight a few key data points from the matrix. In our base case, 3% home appreciation and 7% investment return, Troy leads by $175,000. That's consistent with everything we've shown. In the actual 2015 to 2025 scenario, where the S&P 500 returned approximately 13% annually, the renter's advantage ranges from $227,000 at the highest appreciation rate all the way up to $507,000 at the lowest. These are extraordinary numbers. The critical insight from this matrix: this decision is fundamentally a bet on whether home price growth will outpace diversified equity returns. And across the realistic range of scenarios, the equity market has historically won that bet. This leads us to the verdict. After crunching the numbers through every possible economic weather pattern, the findings are definitive. In our base case, which represents the most likely historical average, Troy beats Alex by a staggering $175,000. But look at the boundary conditions on this slide. For Alex to win, she needs a perfect storm of real estate growth. She needs home prices to rise at 6% or more, while the stock market stays below 5%. Historically, those two things rarely happen at the same time. Usually, a booming economy lifts both boats, and because the stock market is more efficient and has lower carrying costs than the physical house, it tends to lift Troy's boat higher. The key takeaway here for you, the viewer, is risk. Alex has concentrated risk. All her eggs are in one basket, in one neighborhood, on one street. Troy has diversified risk. His wealth is spread across hundreds of the world's most profitable companies. Our sensitivity analysis proves that not only does the renter often end up wealthier, but they often do so with significantly less exposure to a localized market crash. Let's zoom out and look at this decision framework. Based on our analysis, there are 5 factors that determine whether buying or renting wins in your specific situation. Factor 1, the time horizon. How long you stay matters. If you'll be in the home for fewer than 5 years, renting almost always wins. Transaction costs simply overwhelm the benefits of ownership at that time horizon. From 5 to 10 years, it's genuinely neutral. The outcome depends on your specific market and requires a detailed analysis. From 10 to 15 years, there's a slight edge to buying, but it still needs to be carefully evaluated. Beyond 15 years, owning typically wins, because appreciation and forced savings have time to fully compound. Factor 2 is the price to rent ratio, which is home price divided by annual rent. This is one of the most powerful tools for a quick read on your market. If the ratio is below 15, buying looks attractive because renting is relatively expensive. If it's between 15 and 25, analyze carefully. It could go either way. If the ratio is above 25, renting is likely the better move because buying is expensive relative to what you'd pay to rent the same type of home. Given the importance of the price to rent ratio, we'll discuss this metric in more detail on the next 2 slides. Factor 3 is investment discipline. What you do with your savings. This is the most personal factor. If Troy invests his monthly savings, for example, the money not spending on mortgage interest, maintenance, and property taxes, he wins. But if Troy simply spends that money instead of investing it, Alex wins by more than $200,000. Renting's financial advantage is entirely contingent on the renter's financial discipline. This point cannot be overstated. Factor 4 are market assumptions. Home appreciation versus investment returns. At its core, the buy versus rent decision is a bet on whether home price appreciation will outpace stock market returns. And historically, over most 10-year windows, stocks have won that bet decisively. Factor 5, tax benefits. The mortgage interest deduction can benefit higher earners who itemize. And the capital gains exclusion, $250,000 for single filers and $500,000 for married couples, is a meaningful benefit for long-term homeowners. However, as I have repeatedly mentioned, many homeowners today no longer benefit from itemizing under the 2017 tax changes. Of the 5 key factors that I just covered, let me explain the price-to-rent ratio in concrete terms, because it's one of the most practical tools in this analysis. Here is an example of an expensive market. The home price is $1 million. Monthly rent for a comparable home is $3,000 or $36,000 per year. The price-to-rent ratio is 28. That means you're paying just 3.6% of the home's value to rent a similar house for an entire year. Buying that same type of house would cost you 8% to 21% of its value annually in mortgage interest, taxes, maintenance, and insurance. Renting is dramatically cheaper in this market. Now, here's an example of an affordable market. The home price is $300,000. Monthly rent is $2,000 or $24,000 annually for a comparable house. The ratio is 13. You're paying 8% of the home's value to rent a similar house per year. In this case, buying starts to look more attractive because your rent payments are high relative to the purchase price. We tested this across real-world markets with telling results. In San Francisco, with a home price of $1.5 million and monthly rent of $4,000 or $48,000 per year, the price-to-rent ratio is about 31. Therefore, renting wins clearly. In Dallas, at a $400,000 home and $2,000 rent or $24,000 per year, the price-to-rent ratio is 16.7. That's a genuinely neutral market requiring careful analysis using software such as the Atkins Residential Home Valuation Analyzer. And when we look at Cleveland, at $200,000 homes and $1,500 rent or $18,000 per year, the ratio is 11. That's a market where buying makes real financial sense. So here's the intuitive way to think about it. When you own, you're paying 8 to 21% of your home's value every year in total carrying costs. When you rent, your rent payment is simply your cost. If your rent is only 4% of the home's value, renting is much cheaper. If your rent equals 8 to 21% of the home's value, the decision is genuinely close and requires careful analysis. If rent is more than 21% of home value, owning is almost certainly the better financial move. Let's take this analysis one step further by addressing the question of whether to buy a home or rent one from the standpoint of intuition. We've all heard the phrase, renting is just throwing money away. It's a powerful piece of social programming that has driven the American housing market for decades. But if we look at Alex and Troy, we see a different reality. In our model, Alex isn't just building equity, she is also throwing away money on interest, taxes, maintenance, and insurance. To think about this intuitively, you have to stop comparing a rent check to a mortgage payment. A mortgage payment is part savings, the equity part, and part expense, the interest. Rent, on the other hand, is a flat fee for a service. To find the winner, we have to compare Troy's rent to only the unrecoverable portions of Alex's ownership costs, as outlined in the table above. Let's use a machine analogy. Imagine a house is a machine. To keep that machine running so you can live inside it, you have to feed it. Alex has to feed her machine mortgage interest, which totaled over $163,000 in our 10-year study. She has to feed it property taxes at 1.2% of the home's value and maintenance at 1.5%. These aren't investments, they are the cost of admission. In our base case, Alex's cost to carry, the money that disappears forever, ranges between 8% and 21% of the home's value annually. This includes the massive friction of selling the home later, where real estate agents and closing fees take a 7% bite out of her hard-earned wealth. When you see it this way, you realize Alex is throwing away a lot of money just to own the dirt beneath her feet. The rental discount. Now, look at Troy's side of the street. Troy is paying a rental fee that is roughly 4% of the home's value annually. Intuitively, this means Troy is leasing the lifestyle for a fraction of what it costs Alex to carry the lifestyle. If rent is 4%, but the cost to own is 8%, Troy is effectively living at a 50% discount. He doesn't have to worry about a $10,000 roof repair or a sudden spike in property taxes. That is the landlord's problem. Because Troy's total cost is lower and predictable, he can take the extra money and put it into an S&P 500 index fund, which historically has outpaced home appreciation decisively. The real-world rule of thumb. Here's the intuitive takeaway for your own life. Compare the annual rent of a home to its purchase price. If you are paying less than 5% of the home's value in rent per year, you're winning. You're letting a landlord subsidize your lifestyle while you build real, liquid wealth in the market. However, if you find a market where rent is 20% of the home's value, the intuition flips. Buying becomes the bargain. This is why we created the Atkins Residential Home Valuation Analyzer. We want you to stop relying on common sense that might be costing you $175,000 or more over the next decade. We want you to see the machine for what it really is. While on the topic of intuition, let's talk about one advantage buyers have that often gets celebrated and sometimes overlooked in its risks, which is leverage. Here's how it works in Alex's favor. She only invested $115,000 of her own money, the down payment plus closing costs, but she controls a $500,000 asset. A 3% appreciation rate on a $500,000 home generates $15,000 in gains. On her $115,000 investment, that's a 13% return from appreciation alone, even though the market only went up 3%. That's the power of leverage, and it's real. But leverage works in both directions. If home values drop 10%, Alex loses $50,000 on paper. That's a 44% loss on our $115,000 investment. Meanwhile, a diversified stock portfolio, even in a down market, is unlikely to drop 44% on its own. And Troy's investments would very likely decline far less than Alex's concentrated bet on a single home. Here's what's counterintuitive. While leverage magnified Alex's return, it also forced her to put 100% of her net worth into a single asset. Troy, the renter, used no leverage, but his diversified portfolio means he doesn't have to win big to win safely. The most overlooked risk of leverage isn't just the downside, it's the lack of diversification. Alex's fate is tied to one roof, one neighborhood, one local economy. Troy owns a piece of thousands of companies across the entire global economy through low-cost index funds. Leverage gave Alex a multiplier, but it also gave her all her eggs in one basket. Leverage amplifies both gains and losses. It's not a free lunch. That is why the famous financier Warren Buffett once quoted colleague Charlie Munger saying that there are only 3 ways a smart person can go broke: liquor, ladies, and leverage. There's one more dimension to this analysis that doesn't always show up in the financial math: career and life flexibility, and it has real economic value. Let me walk through the table. Job relocation. If a better opportunity appears in another city, Troy can move with minimal cost. Alex faces a difficult, expensive process, potentially selling at the wrong time in the market cycle. We estimate the career advancement potential here at roughly $50,000 over 10 years. Upsizing or downsizing. Life changes. Kids arrive, parents age. A renter can adjust easily. An owner faces a 6% transaction cost every time they move. We estimate $30,000 in flexibility value here. Risk exposure. Again, Alex's wealth is concentrated in one asset, her home. Troy's is diversified across the entire market through an index fund. We estimate $20,000 in risk reduction value. Time commitment. Home ownership demands more than 100 hours per year in maintenance. Troy spends 0 hours. At any reasonable value of your time, that's $5,000 per year. All totaled, the mobility and flexibility advantage to Troy is estimated at $100,000 or more over 10 years. Now, to be fair, there are real advantages to home ownership that go beyond dollars. Owners have full control and autonomy to renovate, landscape, keep pets, and make the space their own. Renters are subject to lease restrictions and landlord approval. That autonomy correlates strongly with long-term life satisfaction. Owners also have the stability and security. No risk of a no-fault eviction or a landlord deciding to sell the building. That peace of mind has genuine value. And homeowners tend to build deeper community ties, civic engagement, long-term neighborhood relationships, social capital. These are real benefits that don't appear in any spreadsheet. The point is, this is not purely a financial decision, but the financial dimension is often misunderstood. And that's what we're here to correct. Let me bring this home. Prioritizing economic reality. This analysis moves beyond paper gains to account for the true cost of carry. By deducting the monthly surplus cost of owning versus renting, we redefine net worth as total resulting wealth. This methodology offers a transparent view of how home ownership expenses actively burn capital that would otherwise be compounding in liquid investments. The critical driver, the rent-to-buy spread. The primary driver of the renter's advantage is the $1,000 monthly discount Troy enjoys compared to Alex's ownership costs. However, this advantage is theoretical unless it is captured. The financial case for renting hinges entirely on the disciplined reinvestment of that full $1,000 difference. The core finding: the American dream is a calculation, not a guarantee. In our base case 10-year scenario, renting and investing the difference outperformed ownership by $175,037, while maintaining significantly higher capital liquidity and geographic flexibility. Sensitivity and swing factors. The outcome is highly sensitive to external variables. While the mobility factor favors the renter, the capital gains exclusion can aggressively tilt the scales toward the homeowner in high appreciation markets. As noted in the sensitivity analysis, market investment returns remain the ultimate swing factor for the renter's success. Final strategic takeaway: there is no universal correct path. The optimal choice is a function of local market conditions, duration of stay, and individual financial discipline. What served previous generations as a wealth builder may, in today's economic climate, act as a wealth dragger. In terms of our recommendations, consider buying if you plan to stay for 7 or more years, your local price to rent ratio is below 15, you value stability over flexibility, you're not a disciplined investor, and you can handle unexpected repair bills of $10,000 or more. Consider renting if you might move within 7 years, your local price to rent ratio is above 25, you are a disciplined investor, you value career mobility, or you want predictable monthly costs without surprise repair bills. If you're somewhere in between, run the detailed numbers. Use a calculator that accounts for all hidden ownership costs, investment returns on your savings, your specific tax situation, local market forecasts, and your personal mobility needs. Atkins Capital Management offers these analytical capabilities, and our cloud-based software is economical, efficient, and effective. Thank you for watching. If you'd like to run these numbers for your specific situation, visit Amazon.com or residentialrealestateanalysis.com to subscribe to use the Atkins Residential Home Valuation Analyzer. Our software is designed to take your specific market, your specific income, and your specific circumstances and give you a data-driven answer on your home purchase opportunity. And finally, it is important to remember that all of the results in this presentation were independently verified by multiple AI systems, including Anthropic Claude, Google Gemini, and high-flyer DeepSeek, to confirm methodological soundness, calculation accuracy, and validate the conclusions. I'm Troy Atkins. Thank you for your time, and make a decision that's right for your situation.